Welcome back. I'm Ross Healy, the chairman of Strategic Analysis Corporation. On Monday, we took a long look at the FANG stocks, where they had been, how they got there, where they are now, and where we think that they might be going. To watch that video, click here. Right now, let's take a look at where the stocks are right now this week. Okay, to begin with, let's remember that the market is only about 5% below its old highs, but the FANGs are not even close. And recall that these are the big gainers, the ones that you really had to hold in recent years to equal, let alone outperform the market. In the last 3 months, the trading range of these companies has become very, very tight. So let's take a look at each stock and see what's going on. Okay, starting off with Amazon, I had reminded you that from the top, the stock had fallen one breakpoint, tried, I think, to follow another one. It would have liked, I think, to have come down a bit further, but the market would have none of it and turned and, of course, pulled the stock along with it. However, it's interesting to observe that Amazon has really not participated in the market's gains. It has just been riding its HB3, which is 16 and a bit times its book value. Now let's take a look at Alphabet, and as I reminded you the first time, Alphabet has fundamentally been trading in a long-term trading range between its mid-growth price, that's 2.5 times book, and its low super growth price, that's 4.5 times book, for the past 10 years. If we take a look at the trading over the past year, here the stock actually came down to that low super growth price, that's the 4.5 times book, broke down, but did not complete its move to the super growth price, which would have given us, I think, a really nice buy signal. Since that time, the shares have been sort of oozing quietly higher, but not, it would seem to me, with much conviction. Now here's NVIDIA. This was a beautiful stock. From its peak up at its HB4, that was 16 times book value. This stock fell right down to its bubble price. That's about 8 times its book value. Had some sloppy trading at each of the breakpoints. Notice that? More sloppy trading at each of the breakpoints, but had a perfect hit and held very, very nicely. Now, since that time, however, there has been a new balance sheet. And what that has done has actually reduced the book per share and kind of left the shares kind of hanging here. Here was the old low, and then here would have been that peak. And you can see that peak resisted these shares going higher and higher. But very, very, very lately, what we've seen here is a potential breakout here. And if that's the case, then we might be able to look for $200 on the stock. And that's, again, as long as that breakpoint holds. Here is Netflix. It had a beautiful top at its HB6, dropped a breakpoint, dropped another breakpoint. I think would, again, have been very, very happy to have finished the job and got all the way down to its HB3, which, by the way, would have been a full 50% price decline. But again, the rebound in the market has pulled the stock back over the HB4 and actually all the way up to its HB5. Again, that's about the 24 times book value. But since that time, look what's happened. Nothing. the stock has just been banging its head on the ceiling. If the market fails to hold the gains of the last few weeks, then I would suggest to you that Netflix would like to work lower. Here is Facebook, a company which can't seem to get out of the way of its own feet. The stock actually rose beautifully right up to its bubble price. That's about 8 times unadjusted book, and of course that gap is the first big problem that this company ran into. Again, look at that. Fell to the break point. Sloppy trading, fell to the next point, sloppy trading, I think would have worked lower and maybe would have given us a beautiful buy signal at the SG price. However, that was not in the market cards. Like Netflix, it pulled back over this technical line and up to the next break point. However, since that time, the stock hasn't been able to do anything at all. And in fact, it just lately has dropped to the low of the recent 3 months, and we're going to see now whether that can hold. Finally, here is Apple, and as I said in our first review of the FANG stocks, notice how beautifully that the MSG price, the mid-super growth, that's 5.5 times book value, had contained the price movement of the stock until very recently, when the company was buying back stock and it had that little run for the roses when it got up to its $1 trillion market cap. However, it got up to its fair market value, had not been above that fair market value line for a long time, and has since that time tumbled below it. It now looks to be rallying back towards its fair market value line, but look what's happened to the earnings forecasts. They have begun to shade lower and lower. I would suspect that the fair market value of $194 is probably going to contain the price. And looking back, remember, on the past 10 years, would suggest to me that that MSG price, which had been the 10-year peak, is probably pulling the stock back down here and perhaps lower in the period months ahead. Okay, so now we know what to look for in the coming weeks with the FANG stocks. This has been Ross Healy, the chairman of Strategic Analysis Corporation, reminding you that nothing, including investments, are difficult if you have the right tools.